Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenborg.
Because it's not how much you make in the markets, it's how much of that you can keep.
Well, folks, I ruffled some feathers last week in the mailbag when I talked about some buffered ETFs. I got a howler letter with someone, a listener, that was complaining and saying I was misguided and, well, wrong. So we're going to talk about that a little bit later. And last week we talked about too big to succeed, these mega RIA aggregators. Captrust is now $1 trillion. Are you going to get a pie charts R Us, or will they still be able to give you customized service? And will you trust your AI, your 401k advice to AI? Methinks not. We got an article in the mailbag about that. And bottom line, it's saying it's good for admin and for little small details, but it's really not good yet for advice. And oh, by the way, companies are now kind of walking back a little bit about the productivity of AI and saying, you know what, it may be not so efficient. And with a cooling economy, are we one bad payroll away from big tech stocks losing their dominance and the whole market giving up the ghost? That may be happening right now, actually. This was an article in the mailbag from a couple days ago, and how apropos is the timing on this? So is big tech too overdone? And more importantly, how will you, with your money, navigate? And that's what we're really going to hit next, coming up. And then the next bear market sparks a retirement crisis, argues David Rosenberg. Well, thank you, Captain Obvious. Every bear market, we always get those people about a retirement crisis, and especially those people that don't have a sell discipline and lose 35 or 40% right along with the markets, and the people that didn't save enough. And now all of a sudden, they're in a big pickle. And we're going to talk about that and sequence of returns. But the problem is, once they lose that big dollar amount, then they lose big, fear sets in. They're too conservative on the rebound. They get worried. They sell somewhere near the bottom. They finally say, uncle. They hit their risk tolerance, their pain threshold, and they sell out. And then they don't, gain on the bounce, on the recovery. And then the whole cycle repeats itself. Does that sound familiar? There is a better way. Revere is here, and we're going to actually show you a better way to do it. And finally, another article is investment considerations during a presidential election year. Now, I know what Don will say. Don will say, just follow the charts. So very quickly, we're going to hit these in reverse order. The investment considerations during an election year. Okay? Basically, it says people care about politics. Markets do not. Stocks tend to do well in the presidential election year. All but 4 of the last 24 election years have had positive returns. And of those 4, 3 of them were 1932, 2000 tech wreck, and 2008, the economic crisis. So 3 of those we were in very turmoil, but in any year where the market's not, or the economy's not just falling apart, we actually have a positive return. It says near-term agendas can help boost sectors. So it depends on the party. So like for Republicans, it's talking about banking, financial, aerospace, defense, healthcare, and oil and gas. Obviously, oil and gas is a big one. With Democrats, renewable energy, telecommunications, industrial, and tech manufacturing. You can read that if you want. The whole point is, the guy says at the end, attempting to position your portfolio around the political outlook isn't likely to be a winning strategy. So stay the course is essentially what he's saying. How about this? How about regardless of whether it's a election year or not, regardless of whether we're in a strong uptrend or a bear market, you have rules around both buying and selling to help you so that you don't get clobbered in bear markets. Because quite frankly, you never know when they'll come. And like we just said, the presidential election year is historically the best year. If you're ever going to bet heavy, you got an ace, the dealer's got a 6. That's the time to make your bet. This is an election year, except when it's not. Well, I'd rather not I'd rather have more rules around that. All right. So let's get right into it. I'd said I ruffled some feathers this week in the mailbag regarding buffered ETFs. So I'm going to read this. This is 727 from Missouri. That's what he put as his name. No, I'm just a retiree, but I do a lot of research. This guy's presentation on buffered ETFs is wrong. I find it disturbing. If he is wrong on something this easy to look up like these, they're not quite that easy. What else is wrong? I'm disappointed and would be happy to discuss with anyone about buffered ETFs. Don, we're listening and would like to discuss. What's so wrong? ? Me. Email me at dan@revereasset.com. I'd be happy to set up a time to discuss. Buffered ETFs are simply a strategy tool like anything else. ETFs, mutual funds, stocks, notes, bonds, etc. And they are not mutually exclusive. You do not want to get married to any one idea or product, and when combined properly, they can help build strong risk-adjusted portfolios. Buffered ETFs work best for shorter time periods when you have a defined time that you will need the money. The more often you have to roll over and chain link them together, the periods, the more variability or variance of returns you will have. This is due to the random time you place the money into the buffered ETF and then rebalance or reset at the end of a specific period. Folks, they go point to point or 6 months at a time, a year at a time, and then they rebalance them. Okay. Let's see, buffered ETFs then rebalance or reset at the end of a specific period with no regard to what the markets are doing, whether it's high, low, whatever. I also said that they're structured to pay around 6%, possibly 7%. This is what he got upset about, I think. In our example, the buffered ETF is capped at 9. In the example we gave last week, this is the show I did last week. You can go listen. In our example, the buffered ETF is capped at 9.8. So that's they're sold, folks, where you can never, well, some of them, they have buffers or certain levels, but the example I was looking at is you can't lose money. So in a down year, you get 0. And then in an up year, you get all the way up. If the market makes 20, you make 9.8. If the market makes 10.5, you make 9.8. If the market makes 5, you get 5, minus their roughly 0.7, 0.75 management fee. Okay. Now, it does not count for dividends. So if the market makes 10%, well, probably 7.5 or 8 with just the price, not the dividend reinvest. So actually, you'd probably get 8. That's another thing you really got to clarify. I also said the structure pay around 6, possibly 7. In our example, the ETF is capped at 9.8. So out of 7 years, and I'm just using an example, you might get the 9.8 max for 4 years. So we're assuming that 4 of those years out of the 7, you got over 10.5%, 11% on the S&P. For 4 years, 0 for 2 years. We've had 2 0 years in the last couple of years, right, where the markets didn't do well. It went negative, okay, because the markets were down, but you didn't lose anything. And then a single year of 5%, ignoring fees, okay? So if you take that and you average that, your annualized return is 6.3. And even giving you the benefit of the doubt, let's add 1 more year and add 1 more max year. So now you have 5 9.8 max years, the same 2 negative years, and a midpoint of 5, and then you increase to 6.75. If that is enough of a return for your goals and you do not like volatility, then these buffered ETFs probably work fine. They're fine. And that's why I also kind of compared it to like a bond fund. However, you will still need a spread or buffer in case your assumptions fall short of the 6.5%. This is because they are not guaranteed just a cap. When you're using ETFs, when the markets are extended, If I were using these ETFs when the market are extended and quite high based on a fundamental valuation, like now, that makes solid sense to me in lieu of a technical sell discipline like we have. Okay. Then after a significant market bottom, in other words, after a bear market, I would leave uncapped and I would skip the buffer. So I'd leave the upside open. And that's how I would use on a longer term with longer term technical indicators to enhance. The main point is that these are being sold. Here's the problem I have with these. It's not that I have a problem with the buffered ETFs. They're all coming out and they're the new thing. They're the new shiny thing. They're coming out in droves and they're all varied. So there's some really good ones and there's some that aren't so good. So you got to do your research, right? But my main point is that these are being oversold. They're being, just like the indexed annuities were being oversold. These are actually taking a shot at these indexed annuities. That's what these things are literally targeting. They're going to steal market share from indexed annuities. Okay. So that's what they're trying to do here. But so they're used is if you have it as a part of your portfolio where it's 30 or 40% of the guaranteed portion, that's going to be sort of fixed income, but with an enhanced return potential. And then you have some that's you're managing. That's one thing. But what people are doing is they're actually building an entire buffered portfolio with the buffer based on the NASDAQ, some based on the S&P, and moving it around. So you're capping all the portfolio. So you're not getting any upside over the 9 or whatever the cap is. Okay. So your average return is about 6-7%. If that's okay, then that's fine. Okay. But don't think you're going to get anywhere near the cap. The thing that they don't talk about enough is how much that cap actually dampens the return. So it's not just about compounding works both ways. We say this on the show all the time, that when you want to protect the downside because big losses, you got to really make it back. So in any event, let me see if I know. I said, my main point is they are being sold as your total market exposure portfolio with the lineup of buffered ETF pie charts that continually roll forward, and you'll be fine. You can sleep at night. If 6.5 to 7 is enough, then you don't have to plan or assume, but don't plan or assume you'll make more. Okay. That's why I was compared to a high yield bond fund. I already told you that. Okay. We are an active manager that manages all sorts of risk, but without caps and similar. Let me read that back. We are an active manager who manages risk sort of similar to buffered ETFs, but without caps and with some drawdowns. But our drawdowns are significantly less than the markets, and we don't use buffered ETFs yet, depending on the evolution there. I never say never. I do like the idea and design of some of the buffered ETFs. I just don't like the way they're being sold and imply that the actual return will be close to the cap. Okay? That's absolutely incorrect. It's generally going to be around 3 to 4% below the cap as a rule of thumb. You really never know until hindsight. That's the problem. Again, you just don't know what's going to happen. What we do at Revere is we measure what is happening while it's happening. We make adjustments accordingly. I hope this was a complete answer, but if not, certainly reach out and we can continue the conversation. And I told him I'd put this in the mailbag so that listeners can hear and see all points of view. Folks, I'm not saying buffered ETFs are bad. I'm saying they're being way overused, or they're about to be, just like the indexed annuities were all the rage. Okay. All right. Ted, can you bring up sequence of returns very quickly? Are you able to do that very quickly? Yes, I can. Because folks, This is very important. Can you show that, Zach, his chart? Okay, this is a chart, and this is that buy and hold strategy, and this is basically assuming if you started investing on January 1st, 1969, that's January 1st, and go all the way through 93, 12/31/93. You start out with $500,000, you make 7.4% average return. You withdraw when you retire 4%. And you increase that 4% withdrawal by 3%. In the scenario one, you had negative returns in the early years. You ran out of money in year 24 based on his pulling the money out. The second example is the exact same thing, but we flip-flop the returns. So the very first return starts in 1993 and then goes backward through down to 1969. So 1969 return would be that number one return in the top left, the 11.3. And because you got some good returns at the beginning and compounding, right? You had over $1.5 million. The returns are the same. The money you started out with the same. It's just the sequence of returns were different. If you take big losses early on, it can really hurt you. So in any event, that's what we were talking about. So now I want to go back over and I want to talk about this very quickly because this is going to set up our discussion today. And that is the fact that we got this, it's in the mailbag, you can read it. With a cooling economy, if we get one bad payroll, could that upset the apple cart? Folks, we got that this morning. The market already sold off yesterday, and now the market is really down today because payrolls, non-farm payrolls, came in at only 114,000 new jobs created. 179 were expected. That's a 36% miss. So they missed by a third. Okay, unemployment rose to 4.3, a 5% increase, and that hadn't been that high since October 2021. So jobs are slowing down quickly. The economy is cooling, and the market now that's going to let the Fed raise quicker and raise more aggressively. But right now, the markets are really starting to sell off hard. And are you making adjustments? Are you changing? We always say at Revere, it's okay to be wrong. It's not okay to stay wrong. Okay? So with that, Ted, I want to talk about how what we've done here, what we've noticed over the last week. Oh, by the way, folks, I wanted to talk. So Don is sick today. He's out with the Rona. He got the coronavirus, and he was actually sounded really good yesterday. He was feeling pretty good, but overnight he got a little bit worse. He's still working and watching the portfolios. He just stopped up and can't talk. And Connor is actually, it's his birthday today, so he went up to spend time with his folks up in Michigan. So we gave him the day off. So it's going to be me, Ted, and Don, but now it's just me and Ted. So Teddy Bull. Now it was Teddy Bull. It might be Teddy Bear now because we got to figure out whether what the market is telling us what we should think. Is the market bullish or bearish? Let's start with the indices and then let's kind of dive into the sectors. Why don't we, Ted? And then tell us what you're looking at.
So as Don usually does, let's start off with the S&P 500. For those who watched my daily videos, the commentary is pretty much the same as last night, but we did get the employment or the jobs numbers this morning. And that is what prompted this gap down and this ruthless selling. And Dan mentioned it before, we had unemployment rate tick up to 4.3% versus 4.1% expected. And we just saw huge misses in expected job numbers. And what that caused was this gap down like I talked about. I just wanted to pan over to TradingView real quick to show huge moves in bond yields this morning, or in other words, bond traders and bond investors piled into bonds this morning, pushing yields down. And what they're essentially discounting is a recession, or at least a slowdown in the economy, which is what all the data is suggesting. So the 1 year, huge move down, some of the biggest moves in over 2, 3, 4 years, down 24 basis points currently. 2 year, down about 20 basis points. 10 year is down about 13 basis points, slicing through that 4% level. So just quickly showing that. And we can go back. I'll go to the NASDAQ. This is off the highs of about 12% now. And so far, we are starting to find support at this prior base high. I've been talking about it as well. So far, we're looking to bounce off this level, maybe reclaim this 450 area, which we just did now. This is coincidentally also right at a key moving average as well. I don't have the daily one up, but we go to the weekly. Is right off the 30-week moving average. As you can see, that's definitely an area of big support in a longer term uptrend. So we are seeing that there's huge volume selling on the weekly as well. And perhaps this is this might put in a short term low. We won't know if this is the lows of this correction until later. So we do not predict in that regard. Actually, going back to the S&P, I do want to bring up a 100-day moving average. Just bear with me 1 second. Pull up a 100-day moving average. And that is exactly where we found support today so far. And that also aligns with this previous breakout level, which we're looking to reclaim now. And once again, on the weekly, it's also at a huge level, the 20-week moving average, which is this green line. As you can see, ever since we bottomed in that August 2023 through November 2023 correction, when we put in that November follow through day here, we've been trending primarily above the 10-week moving average, had that correction in March through April, and found support the 20-week. So that is happening again, although this time a lot swifter and quicker and more vicious, but we are finding support there again. So that is a key level we are watching, the 100-day moving average, which is effectively the 20-week moving average. So potential key areas of support. My expectation here would be a short-term low, maybe a counter trend rally above into 5,500, but that will definitely be a key area to watch out for. My expectation is that all counter trend rallies are shortable. If you don't short, then just stay in cash and wait. And a very key point is that we did get a follow through day on the S&P 500, but none of us own any stocks, and we found no stocks to buy. So along with the follow through day price and volume action that we look for in the indexes, we need to be able to have buyable stocks and setups. And that is very key in our strategy. It's like going to a store that's open, but there's nothing on the shelves. There's nothing to buy. So that's exactly what setups are to us.
Yeah, let me put
Going on.
let me put my Ted interpreter on, because I don't want people to miss that. I know what Ted said, and I'm sure a lot of our stock nerds know what Ted said. But for the retail listener, the one that's not such a stock nerd, so what we do every single night, but every morning, is we look at all these stocks, and we've got certain streams based on revenue growth, earnings growth, institutional accumulation, all these things, and we'll get a universe of maybe 40 or 50 or 60 stocks. In a good market, if it's really bullish and good, you'll get a lot more stocks. And then you may even have to tighten your fundamental screens so that you get a manageable number. If there are too many stocks,
Right.
the screens are too loose. But once you get those, then Ted will go through and look at the charts for technical patterns that have a much higher probability of moving up in the short term.
Right.
Now he's not seeing those. He's saying that, when you start going into correction territory, or the market starts to get ugly, instead of being 40 stocks, all of a sudden it'll be 20 or 18 or 15 or 12.
Exactly.
When they start to getting a single digit in number, that means it's hitting the fan. It's starting to get ugly. If you get none, you've got to be extremely defensive and careful.
Right.
So a lot of the reason that the S&P still does well is there's a lot of rotation within the S&P, but there's also a lot of passive funds that aren't trading that much as well, that kind of help smooth out the volatility. And there's some very, I don't want to say mild, but docile sectors that really don't make a lot of money over the time, especially during growthy times, but they don't go down very much at all. They don't really give a lot back. So in any event, right now, Ted is saying he's not seeing hardly any stocks on his setups, and that's how he knows it's negative. Is that a good synopsis?
Exactly.
Okay.
And when people talk about quote unquote the market, people usually refer to one of the major indexes like the S&P, the NASDAQ, or the Dow. We do have to keep in mind, and we've talked about this on the show, that especially now, the concentration in the S&P and NASDAQ are at ridiculous levels, and then the Dow is just 30 stocks price weighted. And if you really look deeper into the markets, which we can get into later, and look at the action of the leaders, they topped a while ago, some of the liquid leading stocks of this entire bull cycle from the bottom of 2022, topped a while ago and have been seeing distributive action many reversals and breakdowns. So there were many indicators that were indications and signs that leading stocks in the market was giving us that this correction was potentially coming up sooner or later. And here we
And
are.
by the way,
having
folks, by the
correction.
way, leading stocks, they talk about leading stocks. They call them leading stocks because they lead the next bull rally. In other words, whatever leads at the beginning of an uptrend, a stronger, longer term uptrend, generally lead and are the best performers throughout that uptrend. However, when you get toward the end and you start going the other way, those leading stocks, a lot of them, not all of them, but many of them lead on the way down too, because that's where most of the big gains are. And that's where the big hedge funds and pension funds are going to start taking profits. So they lead on the way up, but they also lead on the way down. Sorry, Ted, go ahead.
Right. And another characteristic that we've studied and noticed is that usually the NASDAQ is the leading index in terms of looking whether we think the market is bullish or bearish. And so we did get some exposure. So going on to the mid-cap index, we did find ourselves into the mid-cap areas of the market as we saw some outperformance. And we had this narrative that if the Fed were to cut rates, that'd be very positive for small and mid caps. However, this is not the case anymore because the narrative has completely shifted from inflation's coming down, Fed's going to cut rates, that's good for stocks. But now the market's pricing a recession, and that is inherently bad for stocks. So we got out of mid caps quickly and swiftly to protect downside risk. As you can see, we got out yesterday after the failed breakout. And Don, I mentioned this on the video too. Let me go on a 15-minute chart. From failed moves often comes fast moves, they say, and that's exactly what happened.
In the opposite
Mid-caps
direction.
broke out.
Yes.
Yeah, exactly. Mid-caps broke out after FOMC or the Fed and completely collapsed. If we go to the Russell, same story. Broke out after FOMC, saw a failed breakout, and has
Small
collapsed
caps.
so far. So we've
Russell small caps.
Yeah, Russell small caps. And we've exited our exposure in both those areas of the market. Yesterday, we also got out of our financials, got out of that 1% aerospace and defense sector. And then we also got rid of our Bitcoin yesterday. So now we're really just left with our core S&P exposure. And today, we also trimmed a bit off as well since we are below the 50-day moving average. And we'll just slowly peel back based off our rules, based off the moving averages we look at. And on the flip side, once we start reclaiming some moving averages, seeing some fall through days and seeing leading stocks come back into action, we'll start re-engaging with the markets because it's important to have rules to get us out to take profits. And it's just as important to have rules to get us back in to participate when the market's in the uptrend. Dan, were you about to say something?
Well, I was going to also mention, so I was going to mention, but you cleaned that up perfectly. I was going to say, folks, right now, we only have S&P exposure with a couple S&P ETFs. So we've got literally half cash where we've got a combination of cash and treasury money markets. We have no stocks. Okay. So we started the show a little bit after 10:30 Central Time. And so right before I came in, I looked and we were down about 1.2 and the market was down about 2.5, the S&P. So that's how you manage risk. And you can't just go all in and all out because then you're day trading extremely hard and you get whipsawed. You have to take it off in layers. So we took some layers off when we broke the 21 exponential. We took more off when we broke the 50-day, and we'll have some left, a little bit left until we pull back and possibly break the 100 or 200 day, but you're going to have very little exposure except for the S&P until things firm up.
Right. And another fun fact for the stock nerds out there is that the VIX in the last 1 to 2 years is the second longest period of time since 1990 without 150% move. So recently we got this 100% move now. We'll see if we get the 150% move, but the VIX is essentially just a volatility index, and this tells us that risk is elevated because when the standard deviation widens, or also known as volatility, it's a lot easier to get stopped out and whipsawed and chopped up in these markets. So oftentimes, even shorting is not the best thing to do, as you can get really whipsawed around. less is more in this market, and that is exactly what we are doing right now.
It's sitting
The dollar quickly breaking down as well with the yields. When yields come down, dollar weakens. It's usually a correlation between a country's currency and their interest rates. Gold tried poking its head out, but we're seeing some volatility today, seeing an outside day so far. So still a lot of volatility here. If we go on the weekly, we are actually getting an all-time high close. So that is really significant, and we continue to keep our eyes out here as well. Gold miners coming in as well, but still a lot tighter and more constructive than other areas of the market. Quickly go over silver. Silver is just at the lows of this rectangle base. Nothing really too much to talk about here. Bitcoin, we got out of this after we leaked below the 50-day and after we saw this outside day reversal. And if you saw my video yesterday, a big theme of my video was about these outside day reversals, or in other words, bearish engulfing, where we make a high relative to the high of the previous day, and then we come in and actually engulf the lows as well. And those often lead to key reversals. And I'll just show a couple examples for podcast viewers too. NVIDIA, back here was one, and up here was another. As you can see, both put in short-term tops. And then we had a third one here that led to the second leg in this correction. If we go to SMCI, this was another liquid leader. And what I talked about, how leading stocks give us signs that the markets are starting to get extended or perhaps correction is coming. SMCI actually topped in March on almost an outside day, and an outside day here. And we had that March through April correction. And as the S&P and NASDAQ made new highs, because primarily from the Mag 7 pulling the indexes up, SMCI has been making lower highs and lower lows. And seeing one of the leading stocks do that is definitely not a good sign for the markets. So yeah, those are just some examples of key reversals that we look for that give us an indication that a reversal might be coming. And that is also true for the upside too. So we get one of those on indexes, some leading stocks, maybe potential bottom is in, and we'll play against that.
And so not
bonds.
Only, yeah, hang on. So not only, folks, is it the number of leading stocks that are showing strength, but also the sectors. So fewer and fewer sectors will be showing strength,
right?
And you'll get very few sectors. Folks, in
right.
2008, the only two sectors that made any money were treasury bonds and gold. And if those are both positively correlated, that's a fear trade. It's kind of what Ted was talking
right.
about just 2 minutes ago, how treasury bonds are doing really, really well and gold is holding up pretty well. If those correlations stay strong together, that's bearish for stocks generally.
Right.
Go ahead.
And we talked about bonds quickly. I showed the bond indexes on TradingView. This is just the ETF, just huge breakaway gap as well, because people are piling into bonds as for a safety trade. TLT, pretty much same thing. Just 1, 2, 3, 4, 5, 6 days up in a row. And then, of course, since yields are have an inverted correlation to bonds, we're seeing them sink so far. So this is the 30-year bond yield, and then this is the 10-year. And this tells us that the economy, or at least traders and market participants, believe the economy is decelerating. But when we take the fundamental and macro data as well and corroborate that with the price action of the markets, that's when we can really have conviction that we are on the right side of the markets. So that is the end of the index and interasset correlation. Dan, do you want me to go over the Mag 7 real quick, or do you have anything?
No, go ahead.
You want to talk about before that?
No, go
ahead.
Okay,
so just quickly go over the Mag 7. Apple, we had earnings yesterday. They're a beast of a company. They beat top and bottom line. They're seeing iPads, Macs increase revenues versus the last year. And this is one of the strongest stocks in the market right now. As you can see, we're up 2.54 or 2.5% essentially on 75% above average volume, while, let's just look at it real quick, the S&P is doing this and the NASDAQ is doing this. So what that tells us is Apple's definitely a leader right now, something we'll definitely have our eyes peeled and stalking for when we start turning out of this correction.
Here's some food for thought. Ted, here's some food for thought.
Yep.
or actually for the listeners, I know Ted knows this. Folks, Apple is a $3 trillion company. It, NVIDIA, and Microsoft are the big, mega stocks. If Apple is up over 2.5%, and the S&P and the NASDAQ, of which Apple is both the biggest component or one of the top three, and those indices are all down 2.5 or 3. Think how much the markets would be down if Apple was also down by even just 1% or even just flat.
Right.
I mean, Apple is actually making this market look a lot better than it is.
Right.
Today.
Yeah. If we didn't get that beat and raise, and Apple being the company Apple is, this would have been probably 3% plus down day, like Dan said. Just quickly go on a weekly chart. Extremely constructive, out of the space into all-time highs, finding support near the 10-week moving average, and looking to bounce off this area. So definitely Apple is on watch. Quickly going over the other Mag 7. Amazon, on the other hand, markets do not like its earnings. Complete gap down from the moving average cluster and below the 200-day now. We are rallying back into the 200-day. We'll quickly go on a 5-minute. It will be interesting to see whether we reclaim it or we reject and fail below. And so Amazon is definitely a no-go zone. You can see the RS line has been trending down while we made a higher high, and that's never a good sign when the RS
look
line
at that. Look at that negative slope on that RS line. Nothing good happens below the 200-day moving average.
Yep, and the RS line's making a lower low too, Dan. So not good at all. Microsoft, pretty bad too. Let's go on the weekly for better perspective. We broke out of this pivot area, broke out, and now we failed back in. And once again, from failed moves can potentially come fast moves, and we never want to see failed breakouts. Microsoft, top 3 companies in the S&P and NASDAQ, is back to the 200-day move average. RS line's trending downward as well. So weak action there from Microsoft. And I might have brought this up on a podcast or one of my videos or the weekend video. I talked about how even though AI was extremely hyped up, we are seeing some effects of AI on our daily lives. Many companies did not see the same thing. They did not see the effects of AI trickle into their top line or definitely bottom line growth. So perhaps the mini AI bubble is deflating here for now until the market gets more confidence that AI is actually increasing productivity in earnings and sales. Meta, just a lot of volatility here. We gapped down on the last earnings report, rallied up, tried breaking out all-time highs, failed down again. Now in this earnings, we gapped up, closed at the lows of the day. Let me just get these lines out of the way now. Closed at the lows of the day, and now we're falling through to the downside. And whenever there's that much volatility, it just means institutions have no idea whether they're bullish or bearish. And when they're indecisive, since we ride the coattails of institutions, we want to be indecisive as well. And when we're indecisive, we sit out on cash, and especially we do not touch these names. NVIDIA, arguably the number one leader in the market since the low. As you can see, just massive acceleration in earnings. It's trended so beautifully. And let's just examine the price action real quick. So again, I mentioned those key reversals, right? So we broke out of this base on earnings, we gapped up on 455% year-over-year earnings growth, and then we had this outside day reversal, which put in the top so far in NVIDIA. We broke below the 50, which is usually where we're going to be all out, or we were hedged, so we were able to keep some for the taxable accounts. And then we came back into this 50-day and saw another outside day reversal. We're bearish engulfing. So far, just a lot of volatility right now. That's usually normal in a base building period. So as long as we can hold above this line here, actually this 100 line, still the trend is on. The weekly finding support right here, reclaim the 20-week today. That's pretty much the MA that it has been respecting this entire way up in this 18-month period, which is what this line's. I do want to add one quick hot tip. This line on MarketSmith, let me get rid of that line. This gray line here is the 18-month mark. And the reason why William O'Neill put that line in there is because on average, true market leaders run about 18 months. So we are getting there. If you say the start of the move was the absolute bottom, which I wouldn't say that was where the move started. I would say the move started pretty much when we broke out this base in the stage 2 uptrend. The line is right there now. And from our studies, we've seen that market leaders often have 4 beat and raise quarters. We have 1, 2, 3, 4, 5, 6 now. Arguably beat and raise quarters. Definitely 4 beat and raise quarters. So we are definitely 4 later in the game.
When you say true market leaders, you're talking about true market leaders going forward. That's a strong sign that it will continue. It'll be continuation.
No, so true market leaders usually make a run, and in that run, it has
18
around four beat and raise quarters in about 18 months. So what that means is NVIDIA is definitely in this bull cycle on the later side of an average leader. Of course, that's average. So this could be for years, but we'll just have to see, and we'll have to take it day by day, week by week, and see how the earnings comes in and how AI revolutionizes the world or not.
Now here's another stat. True market leaders also fall in the next bear market, or even just their own stock. If their own stock is having a major sell-off, but true market leaders sell on average 72% from their top. Tesla in 2021 was one of the top 3 best performing stocks. In 2022, it sold off 69%. So it was 3% within that average. So
from a high of 415 Tesla at the top in late 2021 to a low of 102 or 101.81 in January 6, 2023. So really big move to the downside. Go on to Google.
Go ahead.
Sorry?
No, go ahead. Go ahead.
Oh, go on to Google. Also, just pretty weak action so far. Gap down on earnings. So the market doesn't like it so far as well. Was in highs, started breaking below the 8, 21, and 50. So now it's a no-go zone again. RS line is also confirming it. And so just weak action here as well. Netflix, same thing, just trending lower, low 8, 21, and 50 day. Tesla, also disappointing on earnings. Tried the rally, got rejected by the 8 and 21, and back down to the 50. So far, though, in terms of the longer term trend, this 265 area is definitely key, and we're back to this 200-day moving average 40-week area. So definitely need to find support here, or else this might just be another lower high in this longer term downtrend, which we've been in. We are still decelerating in earnings, so that is definitely not a good look for Tesla in electric vehicles. So that's it from Mag 7. I'll quickly pan over to TradingView one more time. This is my Big 8 index. As you can see, pretty much reflects the action of the Mag 7 and plus one more name that I've been talking about, living below 8, 21, and 50 days. So a no-go zone, but at the same time, are finding support at the highs of the previous base and near the 150-day moving average. So this could be a potential area where you can trade against a low, but we don't try to catch lows here. We want to see it and wait for at least some sort of confirmation. And then let's compare that to our RGA index that I've created on TradingView. It's down over 3.4%. And once again, broke out and failed so far. And this seems like it's been the theme of this RGA so far, failed breakouts like we tried here, here as well. So it's just not ready yet. And we'll just have to see what the market brings us in the coming future. So I've gone over all the sectors and indexes. Do you want what else do you have in mind, Dan?
What is your so I'm going to put you on the spot. What is your favorite sector, both, and it can be long or short? I mean, even if you think, semis are just breaking down, I'd short semis. That's an answer. It doesn't have to be long. Just what is your what setup do you think is most intriguing sector wise? And then I want you to tell us your 3 favorite stock setups, and it can include Bitcoin, and those can also be long or short.
Okay. Well, this has been pretty broad selling. So on the long side, I don't really have any favorite sectors.
Okay.
However, we did see some strength in the defensive sectors, but at Revere, we aren't trying to catch every single little rotation, especially into the defensive sectors, because oftentimes institutions park money there temporarily and they quickly sell it off to buy the actually attractive stocks to them. And we rather just sit in cash and be patient instead of chasing the defensive sectors. In terms of to the downside, I mean, semis has been weak for a while. I wouldn't try shorting this here. You already had this huge move down, but maybe if we see a counter trend rally back into the 50-day and it finds resistance also against this 240 level, you can try a short there. You can see this RS line has been just
Now,
decelerating, sinking.
what
So
happens if that stock pulls back a little and then goes up and gets rejected at the 200 again? In other words, if that
that,
goes,
yeah, definitely, yeah, definitely that
yeah,
could be an area to
that would
try to
be a
short.
nice
Yeah,
shorting area, right?
yeah.
Okay,
But short term, though, even those below 200, I would not try to short against 200 because mean reversion is likely. But
yeah,
let's say we broke down here and then we rallied and the 200 is somewhere here. That would be a good low risk area to potentially
okay,
short.
okay.
Um, just, I mean, overall, just a lot of weak action. It's hard to be too favorable with the markets right now, besides the fact that we're at key levels of support. And same with many other mega caps and some leaders are at key levels of support. But our style is we don't try to buy falling knives and buy right at support. We want to wait for at least some sort of
Yeah, we're not trying
confirmation.
to guess the bottom. Yeah,
Yeah, exactly. But I will give you a stock that I've been tracking. I haven't looked at it yet today since we've been on the podcast. So let's see what it's doing. It also gapped down today, but overall, this is still holding up relatively well. As you can see yesterday when we had a broad sell off, it actually had an inside day. And overall, the big picture wise, we're still within this smaller range and definitely still within this range. And on the weekly, this is a new IPO. It's on shoes. We've talked about this before. We broke down this weekly base. You can see earnings are starting to accelerate. And we are building a base on base type action here. So definitely a name I'm watching. I own a pair of On shoes. Connor owns multiple pairs. His dad owns multiple pairs.
I've
Starting
got
seeing
my
these
pair
shoes
on right now.
proliferate. You got your pair right
My
too.
daughter got
Don
me a
has his
pair.
own
Yep,
pair.
my daughter got me a pair for my birthday. Yeah.
Yeah, so this is definitely a name on watch. I know they're definitely pushing, investing a lot of money in marketing campaigns as well. I saw one with Roger Federer, the legend of tennis,
Yep.
with Zendaya, I guess a legend of acting. So
Yeah. Yeah.
definitely attracting a broad base of people into this brand. Um, other than that, Dan,
Yeah. And a great
I'll
pairs
definitely have
trade.
to.
A great pairs trade to go long ON and short Nike.
Yeah, let's look at Nike. Yeah, look at Nike. Last earnings completely crapped the bed. So, no, what's interesting is when new disrupting products come to market, it can often lead to the legacy products and stocks to quote unquote die.
Yeah.
Um, a great example recently um, is Lilly has been in a longer term uptrend, NVO as well, and we know that they developed the GLP-1 drugs, which has been really helping people with weight loss and diabetes. Now let's look at this. Dan, we talked about this on a call. It was down 30% on earnings. DXCM is a glucose monitor, and just look at that.
Yep.
30% down on earnings, can barely rally. Clearly, the stock
Because they're taking
markets
care
are
of the
discounting the
diabetes. They
future.
find a new solution for
Exactly.
diabetes. So Dexcom's demand for monitoring the sugar in the
Exactly.
blood is not nearly as strong
Yep.
because a lot of these people are getting not cured, getting
Yep.
taken care of another way.
And not to go off on a bit too big of a tangent, but while we're on this, just another golden nugget is, as you can see, the earnings has been accelerating for the last 18 months. Why are we down 50% off 52-week highs? Well, Dan, Don, we all talk about this. The market is a discounting mechanism. So this is discounting poorer earnings in the future. I bet you if you look back here in a year, this earnings growth rate right here, these estimates will all be revised down. So
Yep.
just a golden
Yep.
nugget there. If we go on the monthly, broke this huge monthly shelf. So definitely downside is expected. RS line as well, and we have a 6 RS rating. So
Wow.
it's terrible action there. I mean, I could definitely go on to other precedents. For example, Netflix, when it came out, that when Netflix IPO'd, it essentially put in the very top of Blockbuster. So go study that example.
Blockbuster went belly up within a couple of years.
Yeah. And I
that
believe
stock was all the rage, I think
yeah.
in the 80s, I think. 80s, or I can't remember. It was a while ago.
Definitely. And I think it's also same with Coach and another luxury wear clothing brand as well. They also had this divergent action. Yeah. And other than that, I talked about ONON as a favorable name. Honestly, if NVIDIA can find its footing, of course, we'll have to give it a try. But right now, it's not ready either. This is the TML of the market right now. But other than that, yeah, pretty bad distribution days in this last few weeks. And definitely this volatility after yesterday, making a new high relative to the previous day and then failing completely outside the reversal, followed by today's gap down. This is not a market we want to mess with currently. Of course, that can change even in a week's time, but we won't know until in a week. And other names that you wanted me to talk about, I'll have to do my weekend screening, Dan, because right now it's pretty slim.
No. If they're not,
no, I guess that's the message.
Up
it's
and
slim.
Good. That's it.
Yeah.
No, that's what I wanted to know.
It's slim right now.
So, folks, listen. I'm going to give you the clip for the regular investors, not the stock nerds. I'm going to give you the Cliff Notes version, distilled down in a paragraph. Trying to use my AI brain and tell you what Ted said in a nutshell. So at Revere, we're very defensive. We've raised 50% cash, a little bit more. We're very defensive. Right? We've broken certain levels, and we've had 2 rounds of raising cash over the last couple days. And we may continue, or we may hold here. So if the market holds and starts to resume, this looks like a correction on the NASDAQ and a deep pullback, a large single-digit pullback on the S&P. But it's not. It may hold, and it's not just giving up the ghost. Or conversely, it may go ahead and continue, and selling accelerates, and we start approaching the 200-day. And if that happens, we'll get even more defensive. So right now we're holding off on buying, and we're watching the S&P that we have to see whether we've got to let that go or start adding positions around that. Yeah. We're on hold, we're defensive, and that's that. You got anything to add on that, Ted?
Dan, do you want me to give just some concluding thoughts?
Sure.
Okay, so kind of what we're looking for now going forward is you saw this huge move down. This is about 6% on the S&P. NASDAQ actually over 12%. So we're officially in correction territory in the NASDAQ. And I tweet, if you follow my Twitter, I actually tweeted earlier posted earlier that with social media on the rise, with algorithms, market's gotten a lot more emotional, and just with information more widely available. For example, I've showcased Perplexity on here. I saw the Nikkei futures was down 6% this morning. I quickly went to Perplexity, asked, what is going on with the Japanese stock market? And it just spit out all I needed to know, the narrative, the story. So with how quickly information spreads and how easily accessible information is, it's going to be priced in a lot quicker. And so that's maybe what we're seeing. People are thinking the recession's coming. So instead of a dragged on sell-off that goes on maybe for 2-3 months, we get this 1 month swoosh down into correction territory. And that is the nature of the markets now. So we just have to react even faster and be proactive about it.
And that's why you gotta be ready. Yep.
Right. And going forward, now that we have corrected a decent bit, and definitely a nice reversion to the mean, looking at the weekly chart on both the S&P and NASDAQ, we finally saw fear and greed. Now it's back into the fear territory, but early this morning, we're in extreme fear. And this was the first time we fell into extreme fear, I believe, for at least 9 months. So that is a contrarian signal that we look for in terms of sentiment. We're not going to trade basically solely off sentiment, but we do like to see that extreme fear reading. Actually, I do remember now. The last time we saw extreme fear was near the lows of the November 2023 correction that set off this recent bull run. So we do like to see how we back in extreme fear there. Additionally, it's going to be really key to see how future economic data comes in, CPI, PPI, more economic labor market data and manufacturing data, and then as well as the Fed coming up in a couple of months in September. And before, we were pricing in one rate cut in September. After yesterday's manufacturing data, we're down to 80% probability for one 25 basis point rate cut and 20% probability for a 50 basis point rate cut. After today's employment data or labor market data, this has spiked up to 80% probability for a 50 basis point rate cut in September and 20% for one basis point rate cut, 125 basis point rate cut.
And that is why the dollar is dropping and bonds are rallying.
Yep, exactly.
Because of the expected interest rate drop.
Yeah, exactly. So those are just some of the things we're looking for here at Revere. Today's whole theme, we've in the last, let's see, 12 plus months, we've been focused on the grow part of our flagship portfolio, grow protection, and in intermediate times like here, and now, as we're in now, we're focusing on the protection part of grow protection. And that's exactly what we've done. For example, the Qs were up 12%. I checked, we're down about 4.5%, 5% from our highs. S&P was about 6% down from the highs at the lows today, and we're down about, again, 4.5%, 5%. So we are doing our jobs in protecting assets, and we'll definitely re-engage when it's time.
All right, Teddy. Well, it's Teddy Bear right now because Teddy is bearish at the moment. It's not Teddy Bull, but he's dying to get the bull back on, his bull groove back on. The bull groove. That's what we need. We need a tile with a bull dancing to his groove. All right, folks, listen, if you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button. You can put in your name and email address. You'll get our daily market insights videos called Tomorrow's Insights. Every evening, the market is open. Every business day, the market's open. You'll get that in your inbox that evening. It tells you the short-term, mid-term, and long-term strength of the indices and what we're actually doing in our own portfolios. Also, next to it, there's a Contact Us button. You can shoot me a question or tell me you want a complimentary portfolio review or you want a stock talk about on air. You can email any of us, Dan at revereasset.com, Don at revereasset.com, Ted or Connor at revereasset.com, and you can always call us old school at 855 Real Wealth. Because it's not what you make in the markets, what you can keep.